EasyJet closed Friday at 398 pence. That is a 31% decline over 1 year, and more than half its value lost over 5 years. By every standard momentum screen, this is a stock the market has been actively derating. Then a firm called Castlelake, a Minneapolis-based private credit manager with $37 billion under management, looked at that same stock and said it was worth making a public move for. The question is not whether Castlelake is right. The question is what they are actually buying, because it is not the profit and loss account. The FT framing from Friday was precise. Large fleet and expensive airport slots. That is the thesis. EasyJet operates 927 routes across 34 countries. The aircraft themselves are capital assets on long-term lease structures, exactly the kind of collateral that a firm which has spent 2 decades lending to Delta and Qatar Airways knows how to underwrite. Airport slots at constrained European airports, particularly Gatwick, do not depreciate the way brand equity does. They are scarce, regulated, and transferable. What Castlelake is underwriting is not the airline as an operating business generating free cash flow. It is the airline as a collateralized asset pool generating yield on a restructured capital stack. That distinction is the entire thesis, and it is the part most retail holders in EasyJ will not have priced into their mental model of the situation. The consensus read on EasyJet has been fuel costs up, bookings down, losses widening, wrong index. Each of those readings is factually correct, but none of them address what the assets are worth in a breakup or restructure scenario to someone whose primary business is collateral-based lending, not operating an airline. That gap between the operating earnings frame and the asset collateral frame is where this bid lives.
Castlelake did not develop its interest in EasyJet this week. The entry point was assembled over 18 months by 3 separate forces converging on the same stock simultaneously. The first was geopolitical. U.S. and Israeli strikes on Iranian-linked oil infrastructure triggered Iran to close the Strait of Hormuz. 1/5 of the world's oil supply runs through that choke point. Jet fuel prices doubled. EasyJet quantified its March exposure at £25 million in additional fuel costs alone. The airline then guided to a first-half pre-tax loss of between £540 million and £560 million, up from $394 million the prior year. Its fuel hedge position for the second half is 70% covered at $706 per ton, with every $100 move adding or removing roughly £40 million from the cost base. That number matters. A holder trying to value EasyJet on a forward earnings basis is working with a variable that has a £40 million sensitivity to a single commodity move tied to a geopolitical situation that no model can forecast cleanly. The second force was competitive. Bookings are down 2 percentage points for both the June to August and July to September periods versus the prior year. Ryanair and Wizz Air have been taking share on the routes where EasyJet's cost structure is least competitive. The price premium that EasyJet historically charged for Gatwick slots and its network breadth has compressed as competitors added capacity. The third force was structural. In March of this year, EasyJet was relegated from the FTSE 100 to the FTSE 250. Index tracking funds that held EasyJet as an automatic FTSE 100 constituent were forced sellers. That mechanical selling pressure had nothing to do with EasyJet's fundamental trajectory. It was a size-driven event, but it added to the downward price momentum and reset the institutional ownership base. 3 forces, none of them connected to each other, all arriving within an 18-month window. The result is a 31% 1-year decline, a market cap of roughly £3 billion, and an asset base that Castlelake believes is mispriced by a market using the wrong valuation framework.
Under UK takeover regulations, the moment Castlelake issued its public statement on 30 May, a specific clock started. The firm has until June 26th, 28 days, to either announce a firm intention to make an offer or walk away. This is the put up or shut up rule, and it creates a very specific kind of position pressure for every existing EasyJ holder. The holder's decision is not, is EasyJet a good long-term investment? That question has been displaced. The holder is now pricing a binary event within a defined window. Scenario 1. Castlelake makes a firm bid before June 26th. The bid premium, what they would need to pay above the current 398 pence to get board recommendation and shareholder approval, becomes the only relevant number. No credible LBO bid for a UK-listed airline arrives without a meaningful premium. EasyJet's own language about its investment-grade balance sheet and £4.7 billion of liquidity is the management team's way of signaling that a low-ball offer will not get board endorsement. Scenario 2. Castlelake walks away on or before June 26th. The stock re-rates immediately. The takeover premium evaporates from the price. Given that shares had been down 31% before this announcement, the downside return to pre-speculation levels is not buffered by any change in the underlying operating fundamentals. This is the frame that the 28-day clock imposes. It is not a monitoring situation. It is an active positioning decision with a hard expiry date. The precedent is worth noting. Castlelake held talks with Spirit Airlines earlier in 2026 and did not proceed. Spirit subsequently went into bankruptcy. The pattern, interest without execution, is in Castlelake's recent track record. That prior outcome is one data point, not a prediction, but a holder who ignores it is holding an unstated assumption that this situation is structurally different from Spirit. The verification point for this entire thesis is singular and concrete, June 26th. Either there is a firm offer announcement or there is not.
Here is what the Castlelake bull case requires as a logical premise, stated plainly, that a private credit firm can acquire and operate, or restructure and exit, a major European airline without triggering the same debt service spiral that destroyed Thomas Cook in 2019 and grounded Flybe in 2020. Those are not ancient precedents. They are the two most recent case studies in what happens when airlines carry restructured debt loads through a demand shock. Thomas Cook had £1.7 billion in debt when it collapsed. Flybe's rescue deal involved government support and ultimately failed anyway. The pattern in both cases was not mismanagement. It was the sensitivity of airline operating costs to external shocks, combined with the fixed cost nature of aircraft leases and slot obligations. Castlelake's counterargument is embedded in how they have approached aviation historically. They did not try to operate SAS. They took a stake alongside Air France-KLM, which was the operational entity, and then exited. Their business model in aviation is closer to secured lending and structured equity than it is to airline operations. The fleet and slots provide collateral. The operational risk sits with the management team and the remaining public shareholders if the structure is a partial buyout, or with a trade buyer if this is a full take private. But the unstated premise that consensus coverage has been glossing over is this: Castlelake has never fully owned and operated a network airline. Their SAS involvement was a minority position alongside a trade operator. Spirit Airlines talks ended without a deal. The largest single execution risk in this thesis is whether Castlelake's debt underwriting expertise translates into equity governance of a business with 927 routes, thousands of employees, and fuel cost sensitive that can swing £40 million per $100 move in crude. EasyJet's balance sheet is investment grade. Its liquidity is £4.7 billion. Those are real strengths, and they are not the balance sheets of Thomas Cook or Flybe at collapse. That distinction matters. But they are also the balance sheet of a company in the middle of a geopolitical fuel shock, with bookings declining 2 percentage points year on year. The holding period question comes back to 26 June. If Castlelake bids, the frame shifts to premium adequacy. If Castlelake walks, the frame reverts to operating fundamentals. And those fundamentals are pointing to a second consecutive year of widening losses, with an unresolved fuel cost variable tied to the Strait of Hormuz. The verification the market is waiting for is not a revenue recovery number or a route restructuring announcement. It is a single binary decision from a private credit firm in Minneapolis, due in fewer than 4 weeks. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.